Now let's learn about effective annual rates. An effective annual rate is also called an annual percentage yield. The way to think about an effective annual rate is that it's an interest rate expressed that would be applied at the end of the year, only one time. So it's a rate that would be compounded one time, only paid once per year at the end of the year. But it also reflects all the compounding that would have taken place within the year. So if you have monthly compounding, you could be paid interest 12 times during the year, or you could be paid interest one time at the end of the year if you're paid the effective annual rate that would reflect all the monthly compounding that would have taken place. So far we've used annual percentage rates. It's just the interest rate were quoted by a lender, and it did not reflect compounding within the year. So if we were told that the APR was 10%, but that the payments were made monthly, we had to take the 10%, divide by 12 months per year to get a monthly rate. So it turns out that really thinking about things in reverse, the APR was actually calculated by taking some rate that the lender wanted to apply each period, such as they were going to charge you some interest rate each month, and they simply multiplied that by the number of periods in a year. So if it's a monthly rate, they multiplied that by 12, and then they called that the APR, and then they had to tell you it was compounded monthly because the payments were made on a monthly basis. So we've always been given the APR and divided by the number of periods per year to get the rate to apply per period. You could really think the lender did it in the other order. They knew what rate they wanted to charge you each month, so they multiplied it by 12 to quote you an annual percentage rate to be in compliance with the Truth in Lending Act. Well, if a lender quotes you a 10% rate, but they require, say, semi-annual payments, then effectively that's going to cost you more than 10%, because you don't get to wait till the end of the year and pay 10% interest. You have to pay half of the 10%. You have to pay 5% after 6 months, and then the other 5% at the end of the year after the second 6 months. So that is effectively going to cost you more than if you just got to wait till the end of the year and pay 10% interest one time, because you lose the use of part of your money earlier. You pay the 5% rate after 6 months when the 10% APR is compounded semi-annually. The effective rate is calculated like this. We take 1 plus whatever rate per period we're being charged, and then we compound that however many times our loan would be compounded per year. And if we take that 1 back off, that gives us the rate that was actually being charged, the effective rate that was actually being charged over the course of the year. So again, I'll take the periodic rate, I'll add a 1 to it, and compound it some number of times during the year. So think about this term right here as being a future value factor for 1 year's time. It's 1 plus some interest rate raised to some number of periods. That's a future value interest factor. If it's 1 plus the rate per period compounded however many times there are in a year, then this is a future value interest factor for 1 year. So if I take the 1 off, it will give me the rate for a 1 year period of time. M is typically used for the number of payments per year, or also the number of compounds per year. We assume that payments are made with the same frequency that compounding takes place. So if an annuity has a monthly payment, then we assume interest is compounded on a monthly basis. So the number of payments and the number of compounding periods would be the same. So if we're quoted an APR, this formula up here could be expressed this way. It's 1 plus the quoted APR divided by the number of payments or periods per year. In other words, this is our rate per period, our periodic rate, just as we had here. So 1 plus the periodic rate is 1 plus the quoted APR divided by the number of periods per year. We compound that out however many number of periods we have during a year, and when I take the 1 off, that gives me the rate that I would earn over a 1-year period of time. So again, this is just a future value interest factor for a 1-year period of time. It's 1 plus the periodic rate compounded the appropriate number of periods during the year. So if I take the 1 off, that tells me the rate that I would have earned over the year. The rate that would be applied at the end of the year one time, but it would reflect all of the periodic compounding that would take place during the year. So for our 10% APR compounded semi-annually, we know that's 5% for every semi-annual period. So I create the future value factor for the year by taking 1 plus a semi-annual rate, 5% in this case, compounding that twice during the year, and then taking the 1 back off. So if I take 1 plus the 0.05 to the second power, it gives me 1.1025, take the 1 off, and I get 10.25%. So on the calculator, take the 0.1, divide by 2. If we can't do that in our head, we'll use the calculator. 0.1 divided by 2 is 0.05. Add the 1, and that's my 1.05. Raise it to the second power, and then take the 1 off, and I will have earned 10.25% during the year. That is my effective rate. Instead of being paid 5% after 6 months and another 5% after the second 6 months, we could just be paid 10.25% at the end of the year, and it would reflect that semi-annual compounding that would have taken place. So we call that the true cost or the true return on an investment, because it would reflect all the compounding that would take place during the year. The APR is what you're typically going to be quoted, and that's because it has to legally be disclosed. Sometimes you'll be given the effective rate or the APY, the annual percentage yield, as well. And sometimes they want to quote that on certificates of deposit and things like that because the compounding works in your favor. But on loans, they don't necessarily disclose that to you because it's going to show you're actually paying a higher rate than the APR that they are legally required to disclose. So in example 6.9, let's calculate the annual percentage rate and the effective annual rate for 1% per month. Remember, the APR is the rate will be quoted. It's the periodic rate multiplied by the number of periods per year. So for 1% per month, the APR is pretty simple. 1% per month times the number of months in a year, which is 12, so we get 12% APR. Now, we need to know that that 12% APR is compounded monthly. So we know that 12% APR really did come from 1% per month. So without the compounded monthly, we don't really know the origin or the true story for the 12% APR. So for an APR, we have to be told the compounding frequency. So for this case, that's 12% APR compounded monthly. The effective rate for 1% per month is simply 1 plus the periodic rate, 1 plus our 1% monthly rate, 1.01, compounded 12 times during the year with the 1 taken back off. So on the calculator, 1.01, y to the x 12 equals, and then take the 1 off, 12.683% is our effective rate for 1% per month. We could also say it is our effective annual rate for a 12% APR that was compounded monthly. In this example, we were given 1% per month. We could calculate the effective rate by taking 1 plus that monthly rate, compounding it 12 times, taking the 1 back off. That's our effective rate for 1% per month. We also know it's the effective rate for the 12% APR compounded monthly. Now the calculator has a nice convenient feature that will allow us to calculate this effective annual rate perhaps more easily. It's called interest conversion, and it's right above the number 2 key on the calculator. To access the function above the key, we have to use second and then press the 2 key, and that gets us into the interest conversion menus. Nominal means APR. Look in the course notes. Nominal is another name for the APR. This is a field we can either compute or we can enter it. So since we know what the nominal rate or the APR is, we're going to enter it. 12 is our APR or the nominal rate. It's something I have to enter, so I press the enter key. So I've set my nominal or my APR to 12%. Just like the third row keys, the calculator knows you're going to work in percentage terms, so for 12% I put in the number 12. I don't need to put in the decimal representation for 12%. I just put in the number of percent, which is 12 in this case. Then I up arrow. I'm within a 3-screen interest conversion field, so this is the first screen, NOM. Up arrow takes us to the second screen, which is CY, compounds per year. Well, for our 1% per month, that was a 12% APR compounded monthly. The number of compounds per year would be 12 because there are 12 months in a year. Put in 12. This is something you have to enter. So press enter to save the 12 compounds per year. If you'll up arrow again, you'll come to the third screen in the interest conversion menus there, and it says EFF, or effective, which stands for the effective annual rate, or the APY, and it says this is something we can compute or something we can enter. Well, we knew the 12% APR, we knew it was compounded 12 times per year. This is what we want to compute, so we press compute, and we get 12.683%. That is what we got for our effective rate when we used the formula 1 plus the monthly rate compounded 12 times. Take the 1 back off. The nice thing about the interest conversion is you can go back down to the compounds per year and change it and see what would happen. What if that 12%, remember we put in a 12% APR and then we said it was compounded monthly? Well, what if we compounded that daily, put in 365 for our CY and enter it, go back up to effective? Well, the number hasn't changed, the asterisk is gone, and that reminds us we'd have to recompute. So if our 12% APR, the nominal rate, our 12% APR were compounded daily, 365 times during the year, then I could compute and see the effective. It would then be 12.75%. If I wanted to go back down and see what would happen if our 12% APR were compounded quarterly, then I could just overwrite CY with 4 quarters per year, calculate, and that would be 12.551% for quarterly compounding. So the interest conversion can be pretty handy, especially if you just want to look at different effective rates for different compounding frequencies or something like that. The interest conversion feature on the calculator did exactly this for us when we put in that 12% APR and we put in the 12 for the monthly compounding, and we went to compute the effective rate for the 12% APR compounded 12 times per year. The effective rate was calculated by using this formula. The calculator took your APR, it divided it by the 12 compounds per year that corresponded to monthly compounding, got the 1% monthly rate that way, added a 1 to it, and compounded it 12 times during the year, and then took the 1 back off. So the interest conversion has to use that formula to be able to calculate the effective annual rate. You can arrow on up from effective and it'll get you to APR, and so it's just a loop and you can go either direction through those 3 menus. Don't forget, if you go back and change the compounds, when you go back up to effective, you lose the asterisk, you've got to recompute it, and that makes sure that your nominal and your compounds per year do reflect the effective rate that's displayed when you have that asterisk on there. So in Part 610, we want to calculate the future value of $1,000 invested for 1 year at a 12% rate that is compounded quarterly. So that's an APR with quarterly compounding. Envision what would happen over the course of 1 year if that 12% APR were compounded quarterly. You're going to be paid interest 4 times over the year because interest is compounded on a quarterly basis. You're offered 12% for the year, but with it being compounded quarterly, you'll be receiving interest at a 3% rate at the end of each quarter, and that will happen 4 times during the year. So your $1,000 investment would earn 3% at the end of the first quarter, and 3% in compound fashion at the end of the second, third, and fourth quarters. So that would happen 4 times during the year. Your future value factor for the year would be 1 plus your 3% quarterly rate compounded 4 times during the year. So the future value factor over that 1 year period of time would be the 1.125509. That gets multiplied by your $1,000 investment, and there is your future value at the end of the year. Reminder, the exponent key is what we would use there, the 1.03 y to the x4 equals, and then multiply by the $1,000, and that would give us the 1125.51 as our future value at the end of the year. What kind of return have we gotten over the year if we invested $1,000 up front and we had 1125.51 at the end of that year? Well, we would have gained $125.51 in interest. Expressed as a percentage of the $1,000 investment, we would earn 12.551% over the course of that year. That is what we're truly earning on our $1,000. $125.51 increase in value is a 12.551% return over the course of the year. That's the effective rate. In other words, you could be paid interest at a 3% rate at the end of each quarter for 4 quarters, or you could be paid 12.551% one time per year at the end of the year, and that would reflect all the quarterly compounding that was going on during the year. And that is our definition of an effective annual rate, the rate that is paid one time per year at the end of the year that reflects the compounding that would take place during the year. So 3% per quarter is a 12% APR compounded quarterly. It is an effective annual rate of 12.551%. In Part C, we have monthly compounding of our 12% APR. So that means 1% per month. Earning 1% per month 12 times during the year would turn a $1,000 investment into $1126.83. That's earning 1% per month at the end of each month for 12 months. Percentage-wise, you take $1,000 and you grow it into $1126.83, you have gained $126.83 on a $1,000 investment. That is 12.683%. Now, check this in Part E. For our 12% APR compounded monthly, we got a 12.683% effective annual rate. Our definition of an effective annual rate is one that we would apply at the end of the year one time. So it's the rate for the year, thus interest would be applied only one time at the end of the year when we use the effective annual rate. So the $1,000 using that rate would grow into the $1126.83 after 1 year. The quarterly rate, our effective rate was 12.551%, If it were applied one time, the 1,000 would grow into the 1125.51. So we can use our effective annual rate as part of a future value factor for the year if we're only using the 1 year period of time. The effective rate is applied at the end of that year. And the same for the monthly compounding. We'll not cover continuous compounding. You can let me know if you would like to discuss it in more detail. There are some examples in the course notes you could review if you'd like to. The last thing we'll cover in Chapter 6 is an amortization table, which shows us how a constant payment amount will pay a loan down to zero over time. Back in example 6.4, we had 3 annuity payments of $100 at the end of each year. The present value of that annuity was $248.68. We'll use that in an example here to show us that the $248.68 is the present value of the 3 $100 payments. So the 3 $100 payments will pay down that $248.68 loan to zero. So we'll have 3 periods here with our 3 $100 payments. The $100 payment is constant. That's typical for a fully amortized home mortgage. So we'll set up the payment amount to be a constant $100. We're borrowing $248.68 up front. To amortize this loan, I need to calculate the interest that will be charged, add that to the amount I borrowed, and then take the payment off, and that will give me the balance after the first payment is made. So the first line of this amortization table starts with my $248.68 beginning balance. I'm charged 10% on that beginning balance, or $24.87. Then I take off my $100 payment, and that will bring my loan balance down to $173.55. The second period will start with the balance of the loan now being the $173.55, and the 10% interest will be charged on the $173.55. So the interest charged and included as part of the second payment is now down to $17.36. The payment amount is still a constant $100 payment. So here's the balance starting the second period. I'll add the interest for the second period, and then I will subtract the $100 payment, and the loan balance is down to $90.91, and that is what will start the third period, or the third line of the amortization table. I start the third period with a balance of $90.91. I'm charged 10% interest on the $90.91, and then I take the $100 payment off, and that brings the loan balance down to zero. So to illustrate how much of a payment is going to go toward principal reduction, just look at the first line here. $248.68 was the beginning balance, and after the first payment we owe $173.55. Well, that's because the $100 payment in period 1 here had to cover the $24.87 in interest, and the $75.13 had to go to principal reduction. So the payment is divided up among those two things. Another thing to notice, the total of that interest column, 5132, could be verified by taking the total amount we repay on the loan, the total of all the payments, which was $300, 3 payments of $100 apiece, and subtracting the loan amount we were trying to repay in the first place, because anything we pay back over and above how much we borrowed had to be interest. So in this case, the total payments is $300. The $248.68 loan is repaid, so $51.32, the difference there must be the total of the interest paid over the life of the loan. Now let's go through the concept reviews for Chapter 6. At this point, you might want to pause the lecture and read those concept review questions and fill in what you think are the answers. Sometimes it's easier to calculate or set up an example to calculate and convince yourself of those relationships, especially in Chapters 5 and 6. And once you've done that, then restart the lecture from this point, and I will go over what I believe the solutions are to those concept review questions. First one says the present value and the discount rate are inversely related. That's pretty similar to one we did in Chapter 5. the present value is inversely related to the discount rate, because if you discount at a higher rate, you're pulling more interest out each period. Or the other way to think about that is, if you're given a present value that you can invest at a higher rate to grow into the future value, you would actually be willing to take fewer dollars today because you could invest them at the higher rate of interest. The present value of a lump sum is inversely related to time. That's because the longer you have to wait to receive cash, the less it's worth to you today, everything else equal. However, the future value and the discount rate are directly related, because if you invest at a higher rate, you'll grow it into a greater future value, everything else equal. The future value and time are directly related, so if you compound for more periods, you'll earn interest for more periods, you'll have a larger future value, everything else equal. The present value of an annuity due is greater than the present value of the same ordinary annuity, because for the annuity due, you receive the payments one period sooner. So when you calculate a present value, if the payments were to be received one period sooner, they're worth one period more interest. Thus, the present value of that annuity due is greater than the present value of an otherwise identical ordinary annuity. The same is true for the future value of an annuity due. If the payments come sooner, you can invest them sooner, and you'll earn more interest on the annuity due than you would for an otherwise identical ordinary annuity, because for the annuity due, you get the cash sooner, you can invest for one more period. So in either case, you just add one period worth of interest to the ordinary annuity result to get the annuity due result. A fully amortizing loan will have a constant payment amount. The amount of principal reduction included in each payment will increase as the amount of interest charged decreases, because the loan balance declines. So as you make your constant mortgage payment, you're covering the interest for the period and reducing the principal somewhat. And when you turn around and make that same payment the next period, the interest will be charged to the smaller loan balance. Thus, out of that same payment, there's a little less interest and a little more principal reduction in each payment as time goes on. Compounding causes the amount of interest earned each period on an investment to increase, because with compounding you're earning interest on interest, so the amount earning interest becomes larger each period. So even with a constant interest rate, the amount of interest you earn each period will become larger, because you have more dollars earning interest, because you receive interest, plow it back into the investment, you have more dollars at work. So you earn more interest each period because of compounding. If the present value of a lump sum is doubled, then the future value will be exactly doubled. So if we double the present value, as we've said before, if we double this present value, then we will exactly double the future value. If we want to take an example of, say, $1,000 versus $2,000 invested at 10% for 2 periods, in this case, the $1,000 investment earning 10% interest for 2 periods will grow into $1,210. And the $2,000 investment will grow into $2,420, exactly double. If the annuity payment is doubled, then the future value will be exactly doubled. This one is probably best to set up an example for it. Set up an example with some annuity payment amount, and then exactly double that payment amount and keep everything else equal, and see what happens. So say 5 periods, 7% interest, nothing invested today. Invest a $1,000 payment amount versus investing a $2,000 payment amount, and see what we get for the future value. So for 5 in, 7IY, no present value, a $1,000 payment made 5 times will grow into $57.50 and 74 cents. And if we double that payment amount to $2,000 and leave everything else the same, then the future value grows into $11,501.48, which is exactly double our result when we invested $1,000 per period. Now that's not scientific, and we should prove that algebraically, but an example using multiple periods with the same rate and doubling the payment is probably enough to convince us that future value would be doubled. The present value of a 2-period annuity due is more than the present value of the same annuity if it were an ordinary annuity. Yes, the annuity due is always worth more than an otherwise identical ordinary annuity, whether it's a present value or a future value. If a loan amount is doubled, then the payment amount will be exactly doubled, everything else equal. If we borrow twice the money for the same number of periods at the same interest rate, then our payment amount will be exactly doubled. So let's think about that. If we borrow $100,000 versus $200,000, say we're going to make 360 monthly payments either way. And let's use a 6% APR monthly. So that would be 0.5% per month, everything monthly. So number of months, rate per month. Then our payment amount should be twice as large for the $200,000 loan amount than it is for the $100,000 loan amount. I come up with a payment of $599.55 for the $100,000 loan amount. The calculator, of course, put a minus sign in front of that for me there because I'll be paying out that payment. And when I double the loan amount, I get $11.99 and 10 cents, which is exactly 2 times the payment amount. I'm going to check that. Double that $100,000 loan payment and see if you don't get exactly that $200,000 loan payment. And that seems to check out to the penny. So when you double the loan amount, you will double the payment amount, everything else equal. To accumulate a certain future value of an annuity, if an annual ordinary annuity payment is made on a monthly basis instead of annually, the monthly payment will be less than 1/12 the annual payment. So when you make an annual loan payment, then if you decide to pay on a monthly basis, if you kept paying 1/12 of that annual loan payment, then you'll pay the loan down even faster because that monthly payment will chip away at the principal more quickly. So it turns out to be the case that your monthly loan payment is actually less than 1/12 the annual payment because it pays the loan down more quickly. You'll pay less interest than you would on the annual loan payment basis. So your monthly payment will actually be less than 1/12 of that annual loan payment. Total interest paid over the life of a 30-year loan will be more than double the total interest paid over the life of an otherwise identical 15-year loan. That's because that 30-year loan will have the smaller payment. It will pay the loan down more slowly. You'll pay a whole lot more interest over 30 years than you will over 15 years. It turns out to be more than twice as much. That's one where we really probably need to set up an example to convince ourselves that is true. And my setup here is a $100,000 loan amount paid over 15 years on a monthly basis, so 180 months. 6% APR with monthly payments is 0.5% per month. And then I set it up over 30 years or 360 months. So first, with my 180 monthly payments on my $100,000 loan amount at 6% APR, my payment is $843 and 86 cents. The minus sign in front of it, $843.86. If I make 180 of those monthly payments, then the total I pay back is $151,894 and 23 cents. I borrowed $100,000, so everything beyond the $100,000 I pay back is interest. So the almost $52,000 is interest. Now, if I make 360 monthly payments on the $100,000 loan amount at that same interest rate, the payment is certainly smaller. And that's my present value I failed to label. And again, the calculator puts the minus sign there. So my payment amount has dropped by a fair bit, but not all that much when I consider I'm going to be making twice as many of those payments. So 360 payments of $599.55 totals $215,838.19. We borrowed $100,000, so anything over and above the $100,000 we borrowed is interest. So $115,838.19 is the interest, and that is well more than the $51,894 we paid on the 15-year loan. So the 30-year loan will give you a smaller payment amount, but it's nowhere near half of that 15-year loan payment, and you make twice as many of those, so you pay a lot more interest. In fact, in this case, you pay well over twice as much interest on that 30-year loan than you do on the 15-year loan, because that 30-year loan payment is smaller. It pays the loan down more slowly. You pay a lot more interest that way. For a given APR, the APY is directly related to the number of compounding periods within the year. For a given APR, if you compound monthly, you'll get a higher effective rate than if you compound it quarterly or semi-annually or annually. If you compound it even more often, such as daily, you'll get a higher effective rate. So the more often you compound a given APR, the higher your effective rate will be. In chapters 5 and 6, we covered a lot of different topics dealing with the time value of money. We covered the present and future values of lump sums and annuities, how to calculate payments and interest rates. We learned the difference between ordinary annuities and annuities due. The annuity due always being worth more, whether it's a present or a future value, because the payments come sooner. We also learned how to prepare an amortization table, calculate effective rates, and numerous things concerning the time value of money. Arguably, the time value of money is the single most important topic in finance, because the valuation of any financial asset is determined by the present value of future cash flows. So we have to understand present value or time value of money concepts to be able to value financial investments. Now that we've completed chapters 5 and 6, please work the additional practice problems. Again, that homework assignment for chapters 5 and 6 is rather lengthy, so please allow sufficient time to complete it by the due date, which is given in the syllabus. Chapters 5 and 6 will be tested on an exam along with some other chapters. The date, time, and place of that exam is listed in the syllabus, and it will be given in a classroom setting as always. So please complete the additional homework assignments. They're optional, but please complete those prior to completing the Connect assignment, and then practice on chapters 5 and 6 for the exam. Now that you've completed the Chapter 6 lecture, you should work the practice problems in the rectangular boxes if you have not already done so. The solutions to those are found at the end of each chapter in the course notes. You should complete the supplemental homework practice problems at the end of the chapter in the course notes. The solutions to those are on iTunes U, where I work them using the document camera, or the final answers to those may be found on Blackboard in the PowerPoint file posted there. So work them first and then check your answers one of two ways. There's a blank Connect assignment on Blackboard that you may look at before you attempt the actual online Connect assignment. Check the syllabus for the chapters covered and the due date for the Connect assignment that covers this chapter's material. Then you can come to class and we'll go over the solutions to that Connect assignment, and you may ask any questions about it that you would like. Print off that blank Connect assignment from Blackboard and bring it with you, because that's what we will use during class. And if you want to reference your own individual Connect assignment, you should print it off or bring it on your laptop so that we may look at it with you during class. As always, begin preparing for the exam early. Prepare your formula sheet as you go along. Don't wait until the end, but do it as you complete each chapter. And remember, we repost those Connect assignments for additional practice, so you may do them as many times as you like, because the numbers tend to change each time you work it. So there's unlimited practice by reworking those Connect assignments.